So you want to own a data center. No customers walking through a door, no inventory rotting on a shelf, no seasonal slump, no returns counter, no shoplifting, just racks of humming metal, sealed behind blast-proof concrete, generating cash while you sleep. The dream is simple. Rent square footage of climate-controlled space to companies who can't afford to build their own. Charge by the rack, charge by the megawatt. Watch the invoices stack up like cordwood, month after month, from tenants who signed contracts they can't easily walk away from. Here's the paradox nobody tells you at the pitch meeting. The building that prints money the fastest is also the building most likely to strand you with a 9-figure liability the moment the power grid, the client roster, or the depreciation schedule turns against you. This is an industry where a fully built, fully wired, fully operational asset can become worthless in 18 months. Not because nobody wants it, but because it wants too much electricity to be worth wanting. Stick around. We're going to open the breaker panel on this one. Tier 1. Bootstrapped. Somewhere between $200,000 and $1.5 million gets you a converted warehouse, a handful of racks, redundant internet lines, and a diesel generator you pray you never need. This is the edge computing play. A small regional facility serving local businesses who need low-latency storage and don't want to pay hyperscaler prices. Margins here are thin, and survival depends on personal relationships with a dozen or so anchor clients who could, in theory, leave on 90 days' notice. Tier 2. Mid-market. $15 to $80 million buys you a purpose-built facility with real cooling infrastructure and multiple megawatts of contracted power. This tier lives and dies on one number: how many enterprise clients you can lock into multi-year colocation leases before the building even finishes construction. Pre-leasing is everything. A mid-market facility that opens its doors at 40% occupancy is already fighting for its life against the interest payments on its own construction loan. Tier 3. Institutional. Now we're talking $200 million to well over $1 billion. Hyperscale campuses built for the cloud giants, Amazon, Microsoft, Google, who need 100 megawatts of dedicated capacity and don't blink at signing 15-year power purchase agreements. At this tier, you're not really in real estate. You're in the business of guaranteeing electricity will exist, reliably forever, in a specific rural county that just got very interested in zoning law and just discovered its water table matters to a company headquartered 1,000 miles away. Notice the pattern climbing through these tiers. Every step up, the product gets simpler. Racks, cooling, power, but the capital required multiplies by 100 because what you're actually selling isn't space, it's certainty. The promise that the lights stay on and the temperature stays flat, no matter what the grid, the weather, or the market is doing outside the walls. And certainty, it turns out, is expensive to prove. Enterprise clients don't just want a lease, they want an audited uptime guarantee, usually expressed as a tier rating from Tier 1 through Tier 4, where Tier 4 promises fault tolerance against literally any single equipment failure without an outage. Chasing that rating means duplicating everything. 2 power feeds, 2 cooling loops, 2 of every critical system, sitting idle as pure insurance. That redundancy doesn't generate $1 of revenue on its own. It's the price of admission to the tier where the real contracts get signed. Here's the everyday version. Picture a parking garage. You don't sell cars, you sell spots, guaranteed, whether the car shows up or not, and you charge for that guarantee regardless of whether the space sits empty. A data center works the same way, except the spot is a slice of electrical capacity, and the car is a server rack that never leaves, never takes a vacation, and never stops drawing power around the clock. 2 numbers actually run this entire business. The first is PUE, power usage effectiveness. It's the ratio of total energy a facility burns against the energy that actually reaches the servers doing useful work. A PUE of 1.5 means for every watt powering a customer's equipment, you're burning another half watt just keeping the building cool. Shave that number down toward 1.2 or lower, and you're printing margin out of thin air year after year on a fixed physical footprint. Fail to shave it, and your electricity bill quietly eats every dollar of profit the leases were supposed to generate. The second number is the cross-connect. That's the physical cable linking one tenant's rack directly to another tenant's rack, a bank connecting straight to a stock exchange's server, a streaming platform connecting straight to an internet backbone provider, all inside the same building, all without touching the public internet. Co-location facilities charge for these connections individually, sometimes hundreds of dollars a month per cable, and a well-connected facility becomes self-reinforcing. More tenants means more valuable cross-connects, which attracts more tenants, which drives up the price of every remaining cabinet in the building. Here's the part that breaks normal business logic. You can fill a data center to 100% of its floor space and still be losing money, because floor space was never the actual constraint. Power was. A facility can be contractually full at 60% of its physical capacity simply because it ran out of megawatts to sell to new tenants. The building isn't the product. The electrical substation feeding it is, and that substation has a hard ceiling that no amount of clever architecture can raise. This inverts the usual real estate playbook entirely. A landlord with empty units drops the rent to fill them. A data center operator with unsold megawatts can't just discount their way to a solution, because there's no more megawatts to sell at any price until the utility finishes an upgrade that might take 3 or 4 years. Scarcity here isn't a pricing strategy. It's a hard physical constraint written into a transmission line, and it's the single biggest reason operators now compete on power contracts years before they compete on rent. Walk the floor of a hyperscale facility and it looks sterile, almost boring. Cold aisles, hot aisles alternating in strict rows, so cool air gets pulled in one side of a server rack and hot exhaust gets pushed out the other, never mixing. It looks like engineering. It's also accounting, dressed up as architecture. Every design choice, raised floors, containment curtains, chilled water loops, the exact angle of a vent, exists to squeeze the PUE number down by a few decimal points. Because at hyperscale, a tenth of a point in efficiency is worth millions of dollars in annual power savings across a large enough campus. The building is a machine for hiding thermodynamic waste from the balance sheet, 1 degree at a time. The cooling systems carry their own quiet liability too. Large facilities often rely on evaporative cooling, which consumes staggering volumes of water, sometimes millions of gallons a day at hyperscale, in exchange for lower electricity draw. That trade looks brilliant on an energy bill and looks terrible in a drought-stricken county fighting the operator over water rights in public hearings. The building's biggest hidden cost isn't always denominated in dollars. Sometimes it's denominated in gallons, and in the political goodwill required to keep drawing them. There's a liability baked into the concrete that most buyers never model correctly: the power purchase agreement. To secure guaranteed megawatts from a utility, operators sign contracts locking in electricity rates and capacity for a decade or more, often before a single tenant has even signed a lease. If demand doesn't materialize at the pace projected, you're stuck paying for capacity nobody's using, a ghost bill for electricity that never converted into revenue. And if a utility can't deliver the promised megawatts on schedule, entire campuses sit finished, wired, cooled, and empty for years, waiting on a substation upgrade stuck somewhere in a regulatory queue nobody controls. Stranded power, not stranded space, is what actually bankrupts this industry. And it's invisible on a walkthrough, because the building looks completely finished right up until the moment it isn't. The top-line numbers look obscene, and the pitch decks lean into that hard. Hyperscale colocation contracts can run 20 to 30% gross margins on paper, sometimes higher once a facility's fully leased and every cross-connect is billing. But that number hides the debt underneath it, and the debt is where the real story lives. Data centers are financed almost entirely on leverage, construction loans, sale-leaseback arrangements, and increasingly, private credit funds hungry for AI infrastructure exposure at any valuation. The entire model assumes tenants sign on schedule, power arrives on schedule, and interest rates stay manageable across a construction timeline that can run 3 to 5 years. Break any one of those assumptions and the equity holders are wiped out long before the building itself stops working. Cyxtera learned this the hard way. Spun out through a leveraged deal and later taken public via a SPAC merger, the company was saddled with debt obligations that outpaced its ability to service them even as its facilities stayed operational and its clients kept paying rent on time. It filed for Chapter 11 bankruptcy protection in 2023, a functioning revenue-generating business with real tenants and real cash flow, crushed not by demand, but by the weight of its own capital structure. Compute North tells the opposite story. Built specifically to house cryptocurrency mining rigs, the company expanded aggressively on the assumption that power costs would stay low and crypto prices would stay high indefinitely. Neither held. Rising energy costs collided head-on with a collapsing crypto market, and a business model built around a single volatile client base tied to a single volatile revenue stream couldn't absorb the mismatch. Compute North filed for bankruptcy in 2022, a warning that operational friction, the wrong tenant concentration for the wrong economic moment, kills just as fast as a bad balance sheet, sometimes faster. Two very different collapses, one from too much debt against a stable business, one from a stable structure against too volatile a business. The building survived both, the owners didn't. Strip away the servers, the cooling, the marketing decks about the cloud. What's left is one equation: guaranteed power, multiplied by guaranteed tenants, minus the interest on the debt that built the building in the first place. Realistic net margins after debt service and operating costs tend to land between 8 and 15% for most operators, nowhere near the seductive gross figures thrown around in investor pitches and glossy prospectuses. The spread between those two numbers, gross and net, is where fortunes get made and quietly erased. Digital Realty Trust built an empire understanding exactly this, treating power procurement and long-term utility relationships as the core asset, with the buildings themselves almost secondary. Wrapped around a guaranteed electrical supply the company locked in years ahead of demand. The system rewards whoever locks in the cheapest power for the longest term before anyone else realizes what it's worth. Everyone else is just renting rack space inside someone else's electricity contract